Hello and welcome to Easy Money with Don Anders. So we're here with Matt Repass. Matt, if you didn't see our other video that we just did with them, I'll go ahead and link it above about the 3 risks in 2021 to your retirement. But Matt, you're a financial advisor, right? And you've been doing it for a while. I think you've met with tons of people. And you said that you ask one question to everyone. And what is that question?
Question that I pose to every person is, do you know what the annual rate of return in your portfolio and the annual wobble factor, or technically known in our business as standard deviation, how far your portfolio can swing good and bad? Do you know what that is currently?
And I would bet 95% to 99% of people say no.
Correct.
Yeah. Or if they think they know, they don't know. Right. And so why is that so important? So first off, let's break down kind of the two sections of it. Right. So let's start with return. Why is it important that return is in there? Because as long as it's going up and as long as you're not losing money, that's all that matters. Right.
Well, yes, true. But at the flip side of that coin is return. We intuitively want to know what our return is. And just like gamblers that come out of casinos will tell you how much they won, but they don't remember their losses.
Yeah.
And, we tend not to dwell upon our bad stuff. We only want to pick our winners out. That's just human nature. While return's important and it's something that we think about all the time with our portfolios, I think it's the lesser of the two factors that is meaningful, because what an analysis of risk and return does is to obtain the return that you're getting. How much risk are you taking? Because you can have identical rates of return, but your risk can be so out of whack that it's kind of the difference between riding a smooth, flat road, very calm and serene, or getting on a roller coaster and knowing when you hit the peak how far the valley is and then back up and back down. Which ride, especially in retirement, now working, you might like the roller coaster, but it's been my experience over 35 years that once you get to retirement, you kind of like the calm, flat roads and watching the scenery as opposed to worrying about hairpin turns or massive peaks and valleys.
Well, and while you're working, the risk is not that big of a deal, because if it goes down, you're doing what's called dollar cost averaging and you're adding money to the portfolio. So it can actually be okay while you're working, while you're contributing money. The problem is there's 3 stages in retirement, or 3 stages of money. I'm sorry, there's 3 stages of money. Number 1 is accumulation, while you're saving, while you're earning, while you're contributing. So risk can be okay there as long as you have enough time to keep accumulating. Yeah. Then you go to distribution. Distribution is in retirement. You've already saved all the money that you've saved and you basically start distributing it out. And then the last one is inheritance. If you're in that distribution stage, if you're in the stage where you're no longer adding any money, that roller coaster is a big deal, because there's this thing called sequence of returns. And what sequence of returns means, it's when your money drops versus when you have to take it out. And if you say, well, I just won't take out money then, well, guess what? At 72, you have to start taking out money, right? And so it's based on the previous year's value. So if you have a big drop, if you have a 30% drop, well, now all of a sudden, instead of having to take out 4% for RMDs, you might have to take out 6 or 7. And now it gets harder and harder and harder to get back to even. So as you retire, I completely agree. What you want to do is you want to lower that risk, or otherwise known as standard deviation, or like Matt said, wobble factor. You want to lower that and keep the return high. What I tell people all the time is what we like to do for people who want to be in the market, who are okay with that, is when you retire, you want to lower your risk by about half, but keep the returns at about 80 to 90% of where they were. Is that pretty consistent with what you usually recommend, Matt?
Yeah, and the analysis that when I ask and pose this question to people, I said, well, if our goal is to reach some point in the future, go think from point A to point B. If you don't know where you are at present, you can't get to the next point because you can't make a map if you don't know where you're starting from. So it's important to know where you're starting from. What that analysis called results in advanced planning that we offer to anybody, and
we're going to link Matt's website in the description below if you want to contact him.
Right.
This firm.
So if you need to know the answer to this question, because as you mentioned, you'd like to lower your risk and at least keep your return or somewhere close to where it is. Our goal through results in advanced planning is first identify where you are. That same 90% that can't answer, 90+% that can't answer that question, rare is it when we do an analysis, do we find that their return is higher than the annual wobble factor or risk. The wobble factor or risk is usually much higher than what their return is. And through some guidance and reallocating of their assets, we are able to achieve the goal of return being higher than the annual risk. That is the goal in our practice for our retirees, is to maintain return, reduce risk, as you said, where the return is in excess of the annual risk. There are some tools that you and I both use, things called indexing, that people need to be made aware of, that help them smooth that road out as opposed to continuing on the roller coaster ride, which, as you said, in your working life, riding the roller coaster is advantageous. You love to buy. If you could buy something you loved and it was $10 yesterday and now it's $5,
that's great.
Then you load up on it. But if you had to sell in the opposite, you're not going to do it.
Or if you don't have any more money to contribute to buy at the $5, you definitely don't want everything to go down to $5, right?
Right.
I completely agree. And what people don't realize is and a lot of people here, and we talked a little bit about the 3 risk video that we linked earlier, but a lot of people have been retired for 5 or 10 years, or maybe approaching retirement, and they've seen the market do nothing but this.
Right.
They've seen the market go up, and they think it's because they are genius traders, or they think it's because their financial advisor is a genius trader. I have some news for you. Nobody is. No financial advisor is going to beat the market and do all that. What they can do is they can reduce the risk for you. And if they have been doing really well, it's because a rising tide raises all ships. That's it. A rising tide raises all ships. And right now the tide has been rising and all the ships are raising and everyone is looking good right now. But the question is, when the tide goes out, what's going to happen? What are you going to see on the floor shore? You know, or the floor of the river. Matt lives in Ocean City, so he knows all about that. But what we'll do is we're going to link below. If you want to talk to Matt, that's fine. We're also going to link the other videos that we've done with Matt as well. But make sure that make sure that especially if you are retired, you're not taking more risk than you need to get those returns, and also more risk than you're comfortable with. I use another
analogy for risk, and people kind of, if you paint pictures in their mind, I'm sure, Don, you do this, I do this. I said, when you wake up in the morning and you go into the bathroom and you look in the mirror, you have a pretty good idea of what's going to be looking back at you. You're going to be familiar. Well, your hair might be all, and I tell people your hair might be lopsided, or, you got bags under your eyes, but at least you have an idea of who will be staring back at you. Does your portfolio, when you look in the mirror, reflect accurately your vision, what you expect to see? Rare is it that people, especially, here's the lull you to sleep, and when the hammer really hits you. When we get into markets like we're in now, and people have experienced, again, you and I have heard it from our clients to say, oh, guys, you guys are doing great. You're doing great. And my response to them is, no, I'm not doing great. My job is to manage risk. We haven't seen that show up. I'm preparing you for the day when that happens.
Yes.
All the markets are going up. As you said, a rising tide lifts all boats. We want to make sure that that picture in your mind of your portfolio matches what you're going to see in the mirror. Those pictures need to match.
Yep.
And most people's, without the proper analysis, most people's portfolios do not, especially at this point in time, accurately reflect their appetite for risk.
I had one lady who came in, this is a while ago, but she came in and she said, yeah, well, I put all of my money, she's retired, put all my money in small cap stocks because I want small risk. And I said, small cap doesn't mean small risk. It means small company. It means big risk. And I showed her that the portfolio that she was in 2008 would have lost 80% of its value. But she was happy because she was bragging. She goes, yeah, but it did 10% last quarter. And I said, that's a bad thing if you're conservative. That is right. Too much. That is right. that there should be, if something's too good to be true right now, if you're getting gigantic returns and you don't want a lot of risk, maybe something is off there, right? If something is too good to be true, it probably is. Well, I appreciate it. Thank you so much, Matt. Like I said, we're gonna link all of his videos, his YouTube station, and his website in the description below. If you have any questions for him, thank you so much. We'll see you in the next video.
Thanks.
Thank you so much for watching my video. If you want more information about retirement, investing, making money easy, you can go ahead and click here. Or if you'd like to subscribe, it really helps the channel. And then you also get updates when we release new information. You can click here to do that. Thank you so much. Hope you have a great day.